As you know, day traders look for opportunities with the highest reward potential combined with the lowest risk possible. I'm Seth Freiberg, the head trader of SMB Capital's options trading desk here in Manhattan, and one of the most frequent questions that we get revolve around how to structure options trades with terrific reward potential and minimal risk. In this video, we're going to run through a specific options trade setup that has a very high reward potential relative to its risk. So if that's of interest to you, I'd stick around because I think you're going to find this eye-opening. Hi, I'm Seth Freiberg, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really very valuable. Most people think of options income trades as high probability trades that have very high win rates, but smaller rewards when compared to day or swing trades, and that is generally true. But there is a way to structure options income trades so that they can offer the same kinds of risk-reward relationships that you'd be seeking as a day trader. And the purpose of this video is to run you through an example of how to structure an options trade with those same characteristics. So let's take a look, for example, at Goldman Sachs stock, known as GS. And as you can see from this price chart, Goldman Sachs's price remained in a channel between 185 and 215 for about 4 months since mid-July. And so let's say that you felt that GS, having dropped to the bottom of that channel on November 2nd, might be a bullish signal that buyers could start to get active at this level and that you wanted to execute a bullish play using options. In order to teach you this simple alternative approach to bullishly playing GS at this point, I need to make sure that you're clear on how equity options work. I realize that most of you probably know something about how options work, but just for a quick review, and this is going to be fast. What's known as a call option on a stock entitles the buyer of that option to purchase 100 shares of that stock at a certain price called the strike price of that option, regardless of what price the stock is actually trading at. What's called a put option, on the other hand, entitles the buyer of that put to sell 100 shares of a stock he owns at the strike price of that put, again, regardless of what price the stock is trading at. The buyer of the option pays what's called a premium to the seller of the option because the seller of the option is taking the risk that the stock will go past the strike price of the option, in which case the buyer can exercise his option. So in the case of a call, even if the stock has gone way above the strike price of the call buyer can exercise his right to buy 100 shares at that strike price. In other words, he's entitled to buy the shares way below market. He could flip them the next minute and make a huge profit on those shares in that case. Or conversely, on the put option, even if the market goes way below the strike price of the put option, the buyer of that put has the right to sell his shares of that stock at the strike price of the put option that he's bought, even if the strike price has gone way below the strike price of the put, which of course saves him a lot of money compared to whether he didn't own the put and he's stuck suffering a much larger loss on his shares because their price has gone way below what they were worth before, but he had no protection against that happening. So all other things being equal, when a stock price goes up, a call option for that stock will go up because that right becomes naturally more valuable to the buyer. And when a stock price goes down, a put option for that stock will go up because that right naturally becomes more valuable to the buyer as well. So those are the basics of call and put options. Now, before we get into how this trade is structured and how it works, I wanted to let you know that beyond what you're about to learn in this video, there are a large number of sound, viable, long-term techniques for trading options for income. And in that regard, we're currently running a 2-hour free intensive workshop where we'll be teaching you 3 of those strategies that real professional options traders use all the time. In that webinar, we'll be teaching you a really simple but incredibly effective strategy that some of the greatest investors in the world use all the time, plus an options trading strategy that has a statistical 80% probability of profit month in, month out, plus an option strategy that you can employ with a stock that you like where you'll make your target profit, whether the stock goes up, goes nowhere, or even goes down a small percentage. So if you'd like to learn these strategies, then just go ahead and click the link that should be appearing now at the top right corner of your screen. That's going to open up a free registration page in a new window, so don't worry, you won't lose this video. Or you can register for the workshop at optionsclass.com. It's not often that retail traders can be taught strategies employed by actual Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. We've decided that GS is at the bottom of its channel and that we are bullish on the stock. So suppose that we go out to an options chain that expires at the end of November, specifically November 27th, and we buy 5 of the calls at 210 and then turn around and sell 5 of the calls at 215, which is right at the top of the channel. Now, when we do this, when we buy a call at the lower strike and sell a call at a higher strike simultaneously, that combination is known as a call debit spread. So let's break down what is going on here first from a cash flow standpoint. The cost of the 210 calls, as you can see, is $1.30 each, and the cash that we get paid for selling the 215 calls is 82 cents. Now, from a cash flow standpoint, remember, each option represents 100 shares of stock, so you multiply the $1.30 by 100, and we bought 5 of those, so the total cost of the 210 calls was $650. And with that same logic, we received $410 for the 5 215 calls that we sold for 82 cents. So the net cost of entering into this debit spread trade is $240, as you can see from the calculation, which is the most you could possibly lose on the trade and the amount that your broker will require you to have in your account to enter the trade in the first place. Now, let's think through the logic of this trade. So if we're wrong and GS just sells off or doesn't rally and never gets to 210 by November, then, well, of course, you'd lose your $240 because there's no value to either a 210 or a 215 call if the stock closes below 210 on November 27th, because no one's going to exercise their right to buy GS stock at 210 if it's trading below that, and the same goes for the 215 calls. And so both calls just expire worthless. But suppose that we're right and GS gets to 215 by November 27th. In other words, gets to the top of the channel and stops. Well, in that scenario, then the 210 calls would be worth $5. Why? Well, if you exercised your calls for 210 and the stock was trading at 215 at the top of the channel, then in that case, you could immediately sell the shares the next second for 215 and make $5 per share. And you own 500 of those shares because you owned 5 calls representing 100 shares each. And so you'd make a $5 profit per share for a total of $2,500. And the 215 calls, well, they have no value because there's no point in exercising a call to buy the shares at 215 when the stock is trading at 215. So those would simply expire worthless. And so subtracting out the cost of the original debit spread, you can see the trade has a potential gain of $2,260, which is more than a 9-to-1 reward to risk relationship, which for a day or swing trader is an outstanding ratio if you've got conviction in your trading thesis. And incidentally, even if the stock went all the way to 300, you'd still make that same amount of money on the trade, because even at 300, you'd still have the right to buy the shares at 210 and turn around and sell them to the guy who would undoubtedly exercise those 5 calls that you sold him at 215, in which case you'd make that same $5 a share in that scenario as well. So in other words, at any price above 215, you'd make the full profit, that $2,260 on your original trade of 240. So let's move forward to November 27th when these call options expired, and as you can see, GS has closed over 235. And so now let's examine the outcome of the trade, assuming you simply allowed your options to expire and your broker exercised their options on your behalf, which is what would happen. Well, first off, your broker would exercise your right to buy the shares at 210, which would cost $105,000, as you can see. However, the owner of the 215 calls that you sold, his broker would also exercise those calls because the stock is up above 235. So exercising those calls and buying the shares from you at 215 automatically gives him a profit per share of $25. So that call owner would do that, and your account would receive $107,500, as you can see from the calculation. The result, therefore, is a gross cash inflow of $2,500, from which then you deduct your original cost of $240 to arrive at your profit. The maximum we talked about before, that $2,260, which constitutes greater than a 941% return during the 25 days of the trade. So what I'd like you to take away from today's video is that there is a very low-cost way of using options to express swing trading ideas as long as you have a target price in mind that you think is potentially reachable before the trade expires. And those results can far exceed the 5-to-1 reward to risk ratio that most traders would love to have on each of their trades, as you can see in this example. And one other important point I'd like to make: many times when you're in a day or swing trade, you get shaken out of the trade because the stock temporarily goes against you and you hit your stop and have to hit out of the trade. But with debit spreads, the original debit is the stop on the trade. You just let the options expire worthless if the stock never hits your target price, and you take the exact loss you knew you were risking originally. And so you can't get shaken out of the trade. You just stay in the trade till the options expire, because the stock, as frequently happens, may well come back and the gain you were seeking may well happen. Whereas if you were trading the shares, you might get shaken out of the trade only to watch those shares reverse, and in fact, your target price is hit, but you get shaken out of the trade and are unfortunately watching this whole thing unfold tragically from the sidelines. Professional traders like the guys on our desk are well aware of this benefit of using options to express their directional trading opinions on equities, and as a result, they use these option strategies all the time to make great trades, just like the one we showed you in this video. Now, just to remind you, as I said earlier, if you enjoyed this video and learned something valuable from it and would like to learn the details of 3 real-world option strategies that professional options traders use all the time, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing right now at the top right corner of your screen. That's going to open up a free registration page in a new window, so you won't lose this video, don't worry. Or you can just head on over to optionsclass.com to register for this free intensive workshop. It's really a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. And please don't forget to click on the subscribe button right now so you won't miss all of the free trading videos that we're posting constantly on our channel to help you to improve your game as an options trader.